Hey everybody, it is Sunday, 6:46 p.m. Eastern Time. Futures have just opened, and we've got a little bit of a reaction, down about 15 points off of the Democrats using Harris to get the tiebreaker vote in order to pass what Biden promised, which would not be new higher taxes for anybody under 400,000, which it actually is higher taxes. Corporations, Medicare, it's all a bunch of garbage. It basically just breaks down to where individual people making less than 250 grand will always brunt the burden of it. So regardless, not going to get into politics. I'm going to keep this short because I know you guys are here on a Sunday, and it's really just covering what we covered all of last week. Last week, we had a 88 point range, top to bottom, and all of that came within 2 days. Tuesday's low, Wednesday's high. That was the smallest range we have had in almost a year on the SPX. So, for obvious reasons, everybody was frustrated. A lot of people were upset because we weren't getting the volatility that we were used to getting. And the stock market, again, doesn't owe anybody anything. It does what it does. And you had 4 gap downs, 4 red closes, but yet we managed to go absolutely nowhere. So taking frustration out and, putting it into a paper bag and lighting it on fire, that's all that you're able to do in a situation like this, because it is what it is, and that's what you're going to get. And on top of that, I forgot to highlight this. This was on Thursday the lowest the lowest range of the entire year, 26 points over there on Thursday. Regardless of the point, we have climbed 11.9% off of that low at 37.21, which was a buy the dip low, as everybody remembers, 446 points from there. We are up 14.59% from the we are going to bounce, we are going to crash, and then we are going to rally alert from the prior FOMC meeting when we posted that 36.87, and 530 points since then. Since that point, we have had 2 dips, 5%, 5%, and nothing at all. 1.5% last week when we got that 40.80. And yes, it is frustrating, and it should be frustrating because you're not getting the movement that you're used to getting. But there still are trades that can there to be taken. I have a number of people that are messaging me privately. They're doing fantastic. They're taking trades overnight. They're asking me about it. They're going over here. Where I see that a lot of people are having problems and struggling is they're trying to hit home runs and get these 100%, 200%, 500% trades off of this non-moving market. I can't move the markets. I can't go to the markets and tell them, hey, do it, do it. I can't do that. It's not going to, it ain't going to work. Charts are charts. And that's why I said when we went into last week, you want to spread yourself out in a ratio of 1 to 2 or 1 to 3 over the period of August 5 or August 12, even if you wanted to go out further, if you had a little bit of that, because we are in a little bit of a mess as we went up there, and I'll go over it as we start to go into the charts. As of right now, you can see here where we are. Here's your futures, your little dip, and this is what we're doing. This is no answer. You have no answer whatsoever right here. This is coming off of the open from Friday. Friday's open, the big drop, boom, right prior to the open, and this is where we're at. No answers whatsoever with what's going on right here. Zero. Nothing. So, take you on here and walk you through what I have gone through. And again, here is your SPX Weekly. And as you can see, what I'd like to at least be able to display, you see here your problem zones, right? You've got your problem zones right here where you were breaking down and you were supporting And then we broke down through that over here in April, May, and that's 7 weeks down. Then we were resisting it here up in June, and now here we are. There's no drawings on this chart. So you could literally look there and visualize and say, ah, I see it. We're right up here into that same distribution zone that we spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 weeks. We were here. And here we are now. 1, 2, 3, 4, 5, 6. You call it whatever you want. From that point of view alone, I'm telling you here, it's a lot bigger than where it is. Here's the weekly, looking over here onto a more detailed view. And you are already starting to get a warning from being overbought over here on your RSI, over here on your money flow index, and the same thing with the chalk and money flow. And again, you don't need to be a genius to be able to look over here and see the kind of pattern that we're working with, as we're right over here at this support distribution zone, which goes back all the way to March and April of 2021. So, again, it is a very delicate situation. When the first one sneezes, the other one is going to be over there to take the Kleenex and absolutely destroy them and choke them with it. Here is our SPX detailed chart that we've been using for the last weeks. Coming off of our low, boom, 8.5% run right up to 39.45 as we expected. Had a little bit of a dip, not low enough on the dip, but we did get the dip right where we wanted it. Boom, right back up to 39.45. Another little bit of a dip here, lower low, better RSI, buy divergence. Bam, here we are on what looks to be a very strongly completed 5 waves up right to the 200 and the 150, 4180, 4185, right to the bottom of that gap, right over here to that June high. Everything starting to fail, starting to run out of energy, and in need of a dip so that it can be re-energized, so that it can be, from a bullish point of view, pushed back up to the upside. That's what everybody's waiting on. That's the dip that we were expecting and are looking for, so that we can adjust ourselves and be able to determine whether or not it is a buy the dip, or it is that wider view of this is going to get a whole lot worse as we start going into the end of the year. Come over here onto the daily chart. And again, you're starting to see your weakening RSI, which is already overbought on the daily. You've got your support here, which has never been dipped to and retested, which would take you right down to around that 39.50, 3900 level, depending on how quickly they could dip it. You're already starting to get your money flow negative divergence, and you've got your running negative divergence on your money flow over here. So again, big warnings as to why, because we had already reached up in our upside as we went into that FOMC meeting last week, actually almost 10 days ago here, we didn't get our FOMC dip that we were looking to be able to buy. Instead, they just took it and ramped it, and we had absolutely nothing to play with other than that tiny little dip that we got going back a week ago. So again, until we get down into that level and break down below last week's lows, which essentially means getting below that 41.15, which is the Russian invasion line, all we're doing is talking. Until then, we're doing nothing but talking. Come over here onto the QQQ. Again, QQQ. Nearly coming up here to the 20% from the all-time highs line. Getting out of the bear market is what everybody wants to preach. I'm going to show you this. I'm going to display everything as you can see it as to, okay, now I see it. I understand why. Because here I'm looking only at June, coming off of the June lows. Boom, boom. Here's your 1-2, 319.95, your perfect, ideal wave 3 upside target. Bam, broke over it, right up to that resistance line, which falls off. I don't have it on this chart, but falls down, coming off of all of your highs, right there to make it look like, oh yeah, here we are going to break out, but unfortunately you're not. So what we're looking at here on the QQQ is a dip down back below that 313, 311 level for a bullish dip 306, 303 for a little bit of a more bull trap or bear trap, bearish dip. And anything that we get below this 296.60, it's game over. So we're definitely watching it. And again, here on the NDX, same thing. You got your 1-2, perfect to your ideal 161.8 extension. Not taking out the May highs, which was a spike high, but as you can see here, you're right back up to that resistance level, that 50% retracement going back to the March highs, right there at 13,151. So again, looking for a dip on this, somewhere down here to around 12,440 would make the most sense. Back below the June lows. I'll show you here when we get to Tesla in a minute. And again, here on the NDX, this is looking at the weekly, you've got a big warning over here that you are getting up into overbought. Now, you haven't broken up into overbought, but this was a different kind of a market back then, back in 2021. So this is the highest RSI on the weekly, on the NDX, that you've gotten since this dip began. Again, same thing. Weekly warning over here on your money flow, warning over here on your chalk and money flow on the weekly. It's not a 1 minute chart, it's not a 2 minute chart, it's a weekly chart. So it all comes down again to why and how, and this is your why and how. On the S&P 500, we talk about weight. We talk about weight all the time. You got Apple 7.3%, Microsoft 6%, Amazon 3.5%, Tesla 2.2%, Alphabet, Berkshire, massive losses over the weekend when they reported. Down here, number 9, NVDA, 11, old Facebook. But you add these up, the weights, right? And just these 8 guys, these 1, 2, 3, 4, 5, 6, double over here with Google, obviously, NVIDIA, Meta, you got a little bit more than, you got almost 20%, 22, 23% of the S&P 500. You come over on the NASDAQ, and you get the same thing. You got 13, 10, 7, 4, 3, 3, so call it 7, another 3, and then you got another 3. So you talking right here, almost 50%, half of QQQ is just out of these 8 companies. 7. Half of QQQ. Come over here onto IWM, again, same thing, same exact thing. Coming up here, didn't actually make it up there to that 161.8 extension, came very close to it. Ideally, looking for a dip down to around that 181, 182 level, and we'll see what we get. But going back to the NASDAQ, not to lose point, here's Tesla, right? Coming out here, looking at May, coming out there, didn't have it drawn over here on this chart, have it on my other chart that we use for trading. Boom, had your run. And here's your dip. Your dip just back to 23.6 retracement off of that run from 620. 620, 940, call it 50%, call it a little bit more. 23.6 retracement. That's exactly where we wound up there over there on Friday, which is again right to that 857 line that I was calling, right to where basically you're looking at a complete retrace of everything there, 30% from the all-time highs. And come over here onto Apple. Again, looking at the same chart from May. Took out the May highs. On this drop down here, which was a little bit later, you can see this is just nothing but one big wave. But again, up here, looking for a retracement back to around 158. More ideal if we could get a retracement back down there to 152 to get a re-long on this. But again, still looking for something back here to around 158, fill that earnings gap. Amazon, same situation that we've got here on Amazon. From 101 to 143, you do the math, that's 40%. Looking for a retracement dip below 133, get into this filled gap over here from the earnings. Ideally, it would be great to get down to that 122. Not going to force it, but again, you do have this brand new bill that's been passed in Congress. Amazon has avoided paying taxes for years. Now they are theoretically going to need to pay taxes. So we'll see where we go on this. But yeah, again, Over here on Amazon, 40%, looking for a dip somewhere between 133 and 127. AMD didn't take out the May highs. Had a fantastic run, didn't take out the May highs. Should be looking for this to be back down around 100, somewhere closer around that 95 level. Google. Google, in my opinion, you just look at this chart and you look at how simple this chart is and you say, you know what, on Google, I'm just going to sell credit spreads at 118. And that's all I'm going to do. I'm going to sell credit spreads at 118. I'm never going to try and do anything else other than make money by selling credit spreads at 118. I mean, it can't get any simpler than that. Facebook, Meta, ouch. And that ouch comes that in just one more dip lower, and you're going to the December 2018 lows, and that is not good. You'll see those December 2018 lows in a minute. But here, Microsoft, May highs, didn't take it out. Obviously, a very nice move, what we've got going on here. Again, this is Microsoft, but above that 279.76 level, all it's doing is just trapping people, and you can see we've been up here for over a week. Would like to see this dip down back to low below 270, right around that 266 level. We can get a little bit more energy into the stock, and we can see as to whether or not it's something that should be acquired, or if we are going to be looking at that 180, 190 level down below. NVIDIA didn't take out the June highs, didn't take out the May highs. Had a nice run back up there to 189, didn't take anything out. Not good, even though you do have earnings coming out next week. So, not something to really jump around and play with, but obviously NVIDIA is probably one of the most important ones that you want to be paying attention to. Netflix, this is what I was talking about over here. 162 up to 232. You do the math on that, bam, you're looking at obviously something that is definitely looking to get a pullback. 215, 210, 205, ideal. This 230 level, that's your December 2018 lows where Facebook's headed to. Now that's resistance. And you can obviously see this flag that's playing out. Don't even need to draw it on the chart. Obviously looking at some downside over here on Netflix. Netflix, like Google, I would do nothing but sell credit spreads at 230. VIX. Now we're getting into the bread and butter of this. We got down to 2102. And not that 2102 is the bottom. It's not. But 2102 is a very, very large warning sign to say, you know what? Something's wrong with this situation here, and this market is trapping a few too many people to the upside. And again, you come over here, and that's what we got. We got warnings. You come over here and you look, we got warnings. We got warnings. We got warnings. We got warnings. So again, you come over here on the VIX and you start seeing this slope. Not that it's a slope that you need to concern about because the VIX is made to go to zero, but you're coming down into all of my drawn areas of importance. And we're right down here below that 2102, 1, 2, 3 gaps up above. Anything that gets up above into the 30s, anything that gets up into those 30s, you are guaranteed that you are going to get a 5% or greater rally on the SPX. And that's what you are praying for, is to be able to get the VIX up there in the 30s so that you can go ahead and buy the dip like we have for years every time the VIX gets up there into the 30s and we catch the beginnings of a massive rally. When was the last time the VIX was down there up in the 30s? Oh, yeah. That was the FOMC meeting when we had the bounce rally crash. And again, here you come down to on the weekly. This is the weekly. You can see a number of consistent red weeks. The VIX is supposed to do that. But you do have a warning level over here, as you can see how the VIX has now gotten oversold. Only time you were oversold was back here in July of last year, 2021. Come over onto the daily. And on the daily, when you're looking at this, you're looking at, oh, yeah, look at this. We've got a buy divergence on the RSI. So again, more warning signals. It really sucks that last week was more of a setup than it was a play. But again, that was the reason why I made it pretty clear that you want to spread yourself out in a ratio of 1 to 2 or 1 to 3, where you want to have less exposure in the front and more exposure in the back, as to be able to capture all of this. Because again, we've got to our 50 retracement over here at 412. We've not taken out the June highs. Very obviously, we've not taken out the June highs. We're obviously not even close to getting over there to those May highs. Same thing, you've got that major resistance level that you've got over here. You've got a clean flag pattern that has broken over here, rising wedge. What we'd ideally like to see is a dip no lower than around 404 to call this a bullish dip. If we do get a breakdown below that 395 area, then there are some major problems that are taking place, and you've got to have a better look at things. So again, we're here, we're looking into it and getting ready for it, and everybody should be anticipating it. We've got our CPI data that comes out on Wednesday. We've got PPI that comes out on Thursday. China puts out their data tomorrow night on my daughter's birthday. And again, everything is looking clean and ready to be able to finally break out of all of these patterns that we've been in and actually get a little bit of a retracement so that we can get some work done. Over here on crude not finding any kind of bottom still. So still looking for lower over there on crude, down 1% already today as we've getting started. So yeah, again, here on the SPX, we are going to need to break down below 40.80 before anything can be said or done. And on the upside, you've got 41.67 up to 41.85. So we're still stuck. We're stuck. But there is an enormous amount of opportunity that is going to be sitting there in front of everybody once either one of those break. And I tell you, having watched what I watched last week, and you've got this cleanly defined rising wedge pattern over here on ARK, the millions and millions and millions of dollars that went in to the the September puts. This is the number one trade out there right now. Not day trade, obviously not for day trades. This is the number one trade that's out there right now. And to see ARK get a dip down to around 44. So I will catch up with everybody in the chat room. I am not angry. I am not upset. I am not anything. I love everybody equally, other than about 3 people on Twitter. And I'm very much looking forward to this week being a hell of a lot better than last week. So I will catch you guys in the chat room, and I hope you enjoy your Sunday night.